Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week we bring you three things impacting credit markets that we think you should know about. We're grinding down to the close of another year, and what a year it's been. 2022 was all about rate risk. 2023 figures to be all about credit risk, right in our wheelhouse. All right, this week our three things are: 1. KBRA's European ABS survey, fresh insight into investor sentiment. 2. Credit's canary in the coal mine. A Bloomberg survey shows what investors are watching. And 3. Consumer borrowing. It's rising sharply, and it fits the Fed's narrative. All right, let's dig a bit deeper. Improving sentiment. Last week, we explored the topic of credit spreads and why they weren't wider. We noted several reasons, including a fundamental one, investor belief that a possible softer landing was possible, to technical ones of reduced supply and the highest level of yields in 13 years. This week, our European asset-backed research team published the results of a survey they conducted from November 23rd to December 2nd, and the results square up with our thoughts. The authors, led by our head of European research, Gordon Kerr, discovered a more positive turn in sentiment from their previous survey conducted back in June. While acknowledging that sentiment is not overwhelmingly upbeat, it does suggest a more constructive view of credit heading into 2023. Investors expecting ABS spreads to tighten over the next 6 months outnumbered those expecting spreads to widen by nearly 2-to-1. Our survey did find that spread movement expectations did vary across market sectors, with RMBS and ABS investors expressing the strongest expectations for spread tightening, while CMBS and NPL investors continue to express the strongest expectations for spread widening. Only 13% of respondents, however, thought the ABS market in Europe was likely to be volatile and difficult to predict. Concerns over collateral deterioration by country was overwhelmingly centered on the United Kingdom, named by 70% of respondents as the most vulnerable. Still, the survey overall shows an improving outlook for both spreads and issuance as we head into what we see as the most challenging part of this economic cycle. And that supports our broader view that the economic contraction is likely to be relatively mild, with the US less impacted than Europe, and Europe less impacted than the UK. You can find additional details of the survey results in our research piece on our website. All right, on to our second thing, canaries in the credit coal mine. No great surprise, investors are watching leveraged loan performance more than any other marker for insight into the health of the corporate credit market. This, according to a Bloomberg survey released this week. Some 54% of those surveyed fell into this category, followed by 27% citing private credit. But respondents are relatively sanguine about the prospect of markets falling apart. Only 23% expected high-yield yields to be above 10% over the next 6 months. Today, those yields are at 8.6%. Still, uncertainty among investors is clearly weighing on sentiment and preferences. In a world where just as many respondents felt the S&P 500 would rise versus fall over the next month, it should come as no surprise that among portfolio managers surveyed, those expecting investment-grade corporate credit to outperform high yield over the next year do so by a factor of 3-to-1. All right, on to our third thing, consumer borrowing binge. The Fed's consumer credit report for October came out this week, and while growth is moderating a bit from the month-on-month spike we saw back in March, the increase we've seen over the course of 2022 has been unusual. In 2022, the average monthly jump has been $30 billion, more than double the average monthly jump for the period post the GFC to pre-COVID. Revolving credit increased 10.4% year over year in October, while non-revolving credit increased 5.8%. Rapidly inflated housing values clearly has had some impact, but the narrative developing that the consumer is pushing the envelope financially is gaining credence. That narrative goes as follows. The massive pandemic-era stimulus sent savings rates and savings accounts soaring. That excess savings, estimated by the Fed to be $2.3 trillion, fueled profligate spending right through 2022. Excess savings had decumulated by 25% to $1.7 trillion by mid-2022, with the bulk of that held by more affluent households, the segment that doesn't need it and is less likely to spend it. The Fed estimates that households in the lower half of income earners hold just 20%, or $350 billion, of those excess savings. To keep spending levels up to the level Americans have gotten used to, including overcoming the effects of inflation, requires borrowing. Remember, real wages have fallen for 19 consecutive months, thus the jump in borrowing. Markets are starting to express concern related to a weakening consumer. Credit card ABS spreads have widened out to levels not seen since the Euro crisis, if we exclude the outset of COVID in Q1 2020. The reality is, this is a narrative that fits the Fed's policy initiatives. By tightening financial conditions, it intends to push across some near-term pain that will wring out excess demand that has driven inflation to 40-year highs. The goal, of course, is to break the back of inflation so that the mother of all economic evils, the wage price spiral, loses traction. Just be aware of what sectors and names get hit along that policy path. So there you have it. 3 things in credit. 1, KBRA's European ABS survey. Fresh insight suggests that sentiment has improved a bit. 2, credit's canary in the coal mine. A Bloomberg survey shows that leveraged loan performance is worth watching closely. And 3, consumer borrowing. It's rising sharply, suggesting that consumer spending is vulnerable. As always, thanks for joining us. Don't forget to check in on KBRA.com for our latest research and ratings reports. See you next week.